Hi everybody, my name is Morgan Young. I will be leading the discussion today about tax protections for domestic violence survivors. As you can see on the screen, we still have the dial-in information and some other instructions that Colleen went over as to how to get audio, so I know some folks are having problems. Please take a moment and make sure you can hear us before we get started. I'd also like to give the disclaimer as we get going that I am by no means a tax expert. I rely heavily on professionals in the field that do this kind of work, especially folks at the National Women's Law Center and the IRS that really do a great job putting together information, especially information specific to domestic violence survivors. So a lot of that is what I'm going to be sharing with you today. I will answer the questions that may come up the best I can, but if I'm unable to find an answer for you while we are on this session, I am happy to track down that information and get back to you. So let's get started. First, let's take a quick poll. What is the biggest tax concern or confusion that your clients or consumers or survivors, however you like to call them, share with you? Do they want to know if they are allowed to claim their children, whether they qualify for particular credits, how a potential divorce is going to impact their taxes, maybe their ex owes money, or they're not sure if they owe money? What of those things do you hear the most about? Take a few moments and we'll let people chime in on the poll. You can see how people are voting. All right, so a little bit of everything, a lot of bit of everything. So yeah, we're going to talk a little bit about all of these things. Who can claim the kids, who qualifies for credits, how divorce impacts stuff, and whether an ex owes money. It's good that no one seems to be concerned about whether they owe money. So we'll touch on that a little bit, but we'll focus on the others. So starting the tax return. We're going to talk about who needs to file a tax return, and then even if you don't need to file a tax return based on your income, why you might want to if you qualify for specific credits. So filing status is one of the first things that needs to be determined when someone is getting ready to file their taxes, and there are several different choices. Single, married filing jointly, married filing separately, and the head of household or a qualifying widower with a dependent child. And technically the marital status is going to be determined based on the last day of the taxable year. So December 31st, 2015 is what we're talking about for this tax year, unless a spouse died during the year. We're going to talk about how there are some exceptions for domestic violence survivors, but generally those are the categories people are going to fall in. If you are working with someone who's a married survivor, currently married, married individuals don't necessarily have to file jointly. So they might be able to classify themselves as married filing separately. However, that does come with less favorable tax rates and prohibits certain credits from being applied, like the Earned Income Tax Credit and the Child and Dependent Care Tax Credit. So that would be a reason to not want to file married filing separately, though there are some exceptions for some of the other credits. If one is legally separated, that person can file as single or the head of household if other requirements are met. Head of household provides a much better tax rate. So that can be used if the survivor is either single or did not live with the spouse for the last 6 months of the year and is paying half the cost of maintaining a household where the dependent child is living for half the year. So lots of times this is something that we see happening with the people that we work with. They maybe separate earlier in the year, get a legal separation, or have some kind of paperwork started. And then for that second half of the year, they're maintaining a separate household, they're paying the expenses, and the child's living with them. They have primary placement of the child. So they would probably qualify in that case as head of household. If someone is married and filing a joint tax return, it is considered that these individuals are joint and severally liable for the full amount of taxes due for that joint return. So what we see this becoming an issue with is if, let's say, an abuser is filing fraudulent taxes or maybe claiming credits that they're not eligible for, not reporting all of their income, and it's a joint tax return, technically the survivor is on the hook for any kind of repercussions that come from that, any kind of fees, fines, audits. There are some exceptions. If the survivor's signature is forged, because both parties have to sign off on a joint return, the return is not valid because this is considered identity theft. However, we're not just talking about the general definition of abuse when we're talking about, why a survivor would sign. It couldn't just be the dynamics of power and control. According to the IRS code, you have to show that someone signed under duress. And if someone signed under duress, the return isn't going to be valid. You have to prove that at the moment the return was signed, the spouse was unable to resist the demands from the other spouse to sign it, and otherwise would not have signed the return without that pressure from the spouse. So this is a good remedy for folks, but they don't know it's there, and you have to really be able to specifically prove that duress as opposed to talking generally about the power and control dynamics that might take place in that relationship. I would also note that signatures are getting a little trickier now with electronic filing. It's not the case that everyone needs to physically sign something, so the whole typing in your electronic signature, it's a lot easier to electronically forge someone's signature moving forward today. So I think that the rates of this are probably going up with e-filing. So when someone's considering what they should do for filing status and maybe qualifies for a couple different options, they need to determine if their spouse is secretive about financial information. So if they're going to be filing a joint return and they don't have access to all that information because their spouse is secretive, that might not be a situation they want to put themselves in. Or if they don't have access to the family bank account, so they will be cut off from any return that might come in. If they don't know how much their spouse even earns, it would be hard for them to know if accurate taxes are being filed. If the spouse is physically or psychologically abusive, again, putting oneself in the situation where perhaps a fraudulent return is filed, or they don't have any access to any refund that they may be receiving. If the spouse is self-employed, again, having access to those records. Making sure they're good records that are kept for self-employment, because those who are self-employed are far more likely to be audited. Does the spouse control financial decisions for the family? Are you going to be able to have a say in how things are filed? Do you know if your spouse owes any prior tax debts? Because once you are signed on to that account, that could take away any refund that you are owed if there are outstanding tax debts from the past. And is your spouse current with filing his or her returns? If the spouse hasn't filed for some time, that could also complicate whether you can get a refund, whether you're going to get audited, and whether that situation is going to be dragged out more. So knowing these things are simple questions that one can ask to determine what type of status you would be looking at. If folks are getting divorced, there are some possible strategies, particularly if one is working with an attorney. I know that's rare. But if the ex is filing fraudulent returns and you know that the ex is doing so, they're trying to evade taxes, maybe they've always done this, but now is the point where you are aware of it or you're getting out of the relationship, then that individual can file an informant report with the IRS and actually get a cash reward for any taxes that the IRS is able to collect because they have this new information. So depending on safety and some other considerations, that can be a good remedy for survivors who have that information and would like to make the most of that kind of cash award. There is also a really important opportunity when you're filing your marital settlement agreement or your findings of fact, conclusion of law, judgment of divorce, to include a paragraph on the divorce decree that talks about the actual tax implications, saying that the client is not aware of any omitted income, overstated deductions, if there is a joint filing return, that the client believes that the taxes due on the joint return are going to be paid by the opposite spouse if that has been the agreement, so it's actually in writing, and that the spouse will be liable for any tax liabilities and balances from that joint return if that is what has been determined. So having one more order that says that this has been considered and the parties have agreed to this and the court has made this an order is helpful with the IRS later on. Next, we'll talk a little bit about dependents. I saw in the poll that people have questions about claiming dependents and who can do that and how that's beneficial. So where we see this come up the most, particularly with domestic abuse, is stealing tax benefits. So the abuser trying to claim the victim's dependents, legally victim's dependents, for the dependency exemption, for the child tax credit, and for earned income tax credit. And we know that this is incredibly common. So a slightly old statistic, but in 2010, almost 1 million dependents were claimed by more than one taxpayer. So one taxpayer definitely can lawfully claim them, and someone else is also trying to unlawfully claim them, which we know is very common in these high conflict situations. So it becomes a race to file the return. One parent is trying to claim the children before the other parent can get there. Whoever files first usually is able to prevent the second parent from filing, especially electronically. A flag will come up in the system, and it could trigger an audit for both of the taxpayers. So if a parent finds out they're unable to file electronically, they should still go ahead and file by mail. They shouldn't try to delay it while it gets sorted out. They should go ahead and do a paper return. And I have a site on the page that talks about where you can find where you should send your paper return and get a proof of mailing. So it's a good faith effort. You've sent in your taxes, and the IRS will have to sort it out later, but you want to make sure you don't miss any deadlines in the meantime. And if your child has been claimed by someone else, the IRS is going to freeze the returns and the refunds and then look at a tiebreaker rule. So if one claimant is a parent and the other is not, the parent's always going to be able to claim. But if both are parents, which is the common situation we see, you look at who lived with the child longer, or if there's absolutely split 50-50 placement, you look at the parent with a higher adjusted gross income. Or whether there has been a form signed off on, which I'll show you in a second, which is very common now in divorce decrees, talking about one parent filing this form every year to determine who claims the children as dependents. If neither is a parent, which is a rarer circumstance, the claimant with a higher adjusted gross income is going to get to claim the dependents. So Form 8332 that I was talking about is the release or revocation of a claim for exemption of a child of custodial parent. Essentially, this form gets filled out if under the definitions that we just went through, who gets to claim a child, someone has the right to claim a child, but perhaps part of the divorce agreement is alternating years that the parents are claiming a certain child. In the years where the parent should be able to claim the child but is not going to because of some kind of agreement or court order, the custodial parent by IRS definition has to sign off on this form, so it gets filed with the other parent saying, yep, I get to claim the children. I have this form signed off on by the custodial parent. A lot has changed with the new Affordable Care Act and rules about providing health insurance and dependency. So this is probably going to be used less frequently moving forward, or we hope so, with divorce decisions, because it really creates a lot of problems for insurance purposes and claiming the premium tax credit that we'll talk about. But you likely are still working with people where this form was mentioned in their divorce and they are dealing with it. So this is one thing that the IRS will look at. So where else do we see dependents and other issues come up? Mainly in the tax credits. And a quick poll. What is the biggest tax concern or confusion? Oops, that's not the one we want. Sorry, we've already had that poll. We will skip that. I apologize. But we're going to talk about the main tax credits that people have, and that poll was supposed to ask you which credits they have questions about specifically. And we're going to talk about credits because they are really important and are meant as tools. They're built into the system as tools to lift people out of poverty. And it doesn't work perfectly, but as you can see on this chart, this is a 2013 study talking about the Earned Income Tax Credit and the Child Tax Credit. It really did provide a huge financial boost for a lot of people, to the tune of 31.7 million individuals who received significant financial benefit, were either made less poor by definition or actually lifted out of poverty altogether. And of those 31.7 million, 13 million are children. So it's really the most vulnerable people in the population. So it's important that people take these credits when they're available to them. The main credits we're going to talk about, like I said, the Earned Income Tax Credit and the Child Tax Credit. We're also going to talk about the Child and Dependent Care Tax Credit and the Premium Tax Credit, which is attached to health insurance now with the new Affordable Care Act. You can receive all these tax credits if you're eligible, so it's important that people know what they are and if they qualify. So there are a couple different ways that tax credits work. Taxes lower the amount of taxes owed or provide a refund. So they can be non-refundable or refundable. If a tax credit is non-refundable, it's going to lower the tax bill, but it can only go down to zero. You're not going to get a refund on a non-refundable credit alone. So if you had a $500 tax bill but you had a $700 non-refundable credit, you don't owe any taxes, but you're not going to get that $200 back. If you had a refundable credit, which most of them are, you can actually get a refund even if you don't owe the taxes. So if you had a $500 tax bill but you had that $700 credit, you would get a $200 refund in that case. And we'll talk about which qualify as which. Earned income tax credit is the one we hear the most about because it provides the biggest financial boost and the most people qualify for it. It is a wage supplement for low and moderate income workers. That said, while a huge population qualifies for these, the IRS estimates that at least 1/5 of eligible taxpayers aren't even claiming this credit. So it's really important that people know about it. To file for the EITC, you have to be married filing jointly, single, or head of household. So this is one of those ones where you can't be married filing separately. And this is a determination that people need to take into consideration when they decide what status they're going to file as if they have options. So married filing separately will not qualify for EITC. There are limits, and the 2015 limits you can see on the screen. If you are single, you have no qualifying children, you can get up to $503 if you don't make more than $14,820. And you can see how the income cap goes up depending on how many qualifying children you have, as does the amount you can get. So if you have 3 or more qualifying children, if you are filing singly, you can make up to $47,747 or $53,267 married filing jointly, to get up to $6,242. So this is a significant amount of money for a lot of individuals. To qualify for the EITC, you have to have some earned income. So folks that are not working at all are not eligible to claim the earned income tax credit. So this is supposed to supplement money that you've made. This can include combat pay, and you can have unemployment or other benefits, but you need to have also had some earnings during the year. And that might disqualify some individuals that you work with. But if folks even worked a little bit during the year, they would potentially qualify. This is not going to be a credit that everybody has access to, particularly individuals that are undocumented or have some kind of lesser legal status through immigration. You have to be a citizen, a legal resident, or you have to be married to one. And you have to have a valid Social Security number. So the tax ID number does not qualify for the earned income tax credit. You have to have a Social Security number. Claiming children for the earned income tax credit. So if you are trying to figure out if a child is technically connected to you, you have to be related to the survivor or adopted or a foster child. The child has to live with the individual for over half of the year and be under the age of 19 or 24 if they're a student, and if the child is disabled, there's no age limit. So it would be seen as a dependent disabled adult child. Wisconsin also has earned income tax credits. You can see the chart on the bottom. It's based on the federal credit that we just discussed. So if you have no children, you are not eligible for the Wisconsin earned income tax credit, unlike the federal earned income tax credit. So 1, 2, or 3 or more children are going to cut you a percentage of what you got for the federal credit. So if you have 1 child, you can get 4% of the federal credit for a maximum of $134. And you can see how that increases with the number of children you have. And I have the chart on the top because I think it's worth noting that Wisconsin has done what I would consider some really shady stuff with our earned income tax credit, which also affects, how much money we have going into this pot. Because, and all states do this differently, but we get money from the feds for TANF, so assistance for needy families. Now, instead of taking the money that goes to the earned income tax credit out of our general revenue, we, as you can see, are still taking a bulk of the money that goes into our earned income tax credit that we're paying out to people from TANF. So it's taking other funds that are supposed to be assisting these individuals and pumping them into the tax credit instead. That's a choice that our government makes, so if you ever see any kind of legislation or anything come up about this, you can feel free to contact your local representatives. So Wisconsin Earned Income Tax Credit, you have to meet the following criteria. You have to qualify first for the federal tax credit, so if you didn't, that wouldn't work. Like I mentioned, you have to have a qualifying child. You have to be a full year Wisconsin resident, and you have to file a joint return if you're married. However, there is the same exception that we saw at the federal level. You can claim the credit on a separate return if you paid more than half the cost of keeping up a home, if your spouse did not live at home during the last 6 months of the year, and the home was for more than half the year the principal home of the child. That makes you eligible for this exemption. There's also the child tax credit. And this is intended to help offset the cost of raising children. A survivor can claim up to $1,000 per child no matter how many children they have. So you have 10 kids, we're talking $10,000. The example I give is Jane is a single mom with 2 kids. She earned $8,500 in 2013. She can claim $2,000 for her tax credit. So it doesn't matter at that level of income how much she made. She has the 2 kids, it's a $2,000 credit. However, at some point income does get taken into account. So if you are married filing jointly, there is a cap at that $1,000 once you hit $110,000 as your joint income for the year. If you are single, head of household, or a qualifying widower, you can't make more than $75,000, and married filing separately, $55,000. And after that, the $1,000 amount per child starts to taper off a little bit. How do you claim? The child who is claimed must meet the relationship and residency requirements. We talked about that, and can't be over age 17 and must be claimed as a dependent. So you can't just have a child out there that you're not claiming as the dependent, and the tiebreaker rules that we talked about as to how the IRS determines who gets to claim the dependents go into effect. Married survivors can file jointly or separately, and you can also claim this credit if you are filing as single or the head of household. If a survivor doesn't owe enough taxes to use all of the child tax credit, you still might get that as a refund. So if the survivor will receive either 15% of her income above $3,000 or the amount of the child tax credit that exceeds her tax liability, whichever is less. So this is one of those situations, it's a refundable credit, so even if that would bring your taxes owed down to zero, you can get money on top of that back as a refund. So for example, Jane has 2 kids. She earned the $8,500 in 2013. Sorry, make that 2015. She has no income for tax liability. She doesn't need to pay. She's making too little money. She will receive, by that calculation, $825 from the child tax credit. There's also the Child and Dependent Care Tax Credit, which is pretty straightforward. It can help survivors meet their child and dependent care expenses. Essentially, if you have child-related expenses, daycare, things like that, because you are working or looking for work, those would be the allowable activities, you can offset some of those costs. So survivors get a percentage of eligible expenses. Again, this is going to be based on their income. And as I mentioned, eligible expenses would include any kind of paid child care and care for disabled dependents who live with the survivor. This can include before and after school care, summer day camp, etc. If you are at work or actively looking for work and unable to care for your kids directly yourself and you have to pay someone else to do that, those would be eligible costs. It's capped at $6,000 for 2 or more children or dependents and $3,000 for 1 child or dependent. This is not refundable. So again, this is one of those expenses where if it would bring your taxes owed down to zero, you don't get extra money back as a refund on top of that. It just takes away your tax liability. The survivor, to claim any of these credits, is going to have to file the federal and state tax returns. So folks that wouldn't necessarily need to file otherwise, if you want to get this money back, you have to file. And the regular 1040 form works, the 1040A, but not the 1040 easy file. So some people prefer to do the easy file because maybe they don't owe taxes. It expedites the process. You can't use the 1040 easy form. Now, if you use any online tax filing system, it's going to know. It's going to fill out the appropriate paperwork for you. It will guide you through the questions whether you have these credits accessible to you. So filing online will straighten this out, but for folks that prefer the paper forms, you need to make sure you're not using the 1040 easy. And then you're going to have to file a separate form for each credit. Each credit has its own form. Again, if you're filing online, not a problem. It's all incorporated into the online system. You can also file and correct returns for years prior to 2015. So generally you can go back 3 tax years and file amended taxes or file taxes even if you didn't have to file in the first place. So if you're working with someone who wasn't allowed access to anything, didn't file with their spouse, didn't make any money, and suddenly becomes aware that they have the ability to claim these credits and probably have for the last few years. Perhaps they've been single and out of the relationship for a while, or it was a non-marital relationship. They might become aware of this information and be able to go back and file the last 3 years of amended tax returns and get those refunds and credits that are due to them from the past. So this is really important to make sure people have this information, because that can add up to quite a bit of money. We're also going to talk about the premium tax credit. So this is the tax credit that is through the Affordable Care Act. Essentially, if you are signing up in the marketplace for health insurance and you make below a certain amount of money, you are eligible for a tax credit to offset that cost of health insurance. This is part of Obamacare, the Affordable Care Act that came out. And so we wanted to cover it a little bit, even though some of the rules can be a little confusing. Essentially, this is a credit that a lot of people are going to be eligible for. And it is based on household income. So as you can see on the chart, they designate if you're making between 100% of the federal poverty line up to 400% of the federal poverty line. So one person has to make between $11,670 up to almost $47,000. You would be eligible for a premium tax credit based on the health insurance that you paid. The family of 2 and the family of 4 obviously have much higher federal poverty line amounts. So a lot of people qualify for this tax credit, but it works a little bit differently for most people than a lot of the other credits we've talked about. Again, you can't file a married filing separately tax return unless there are these qualifications that you would meet. And a lot of victims of domestic abuse and spousal abandonment might be able to do this. So this is one of the credits where even if you have a survivor who really has to file as married filing separately, gets the lower tax or gets the less beneficial tax rate, you still might be able to claim the premium tax credit if they can say they're living apart from the individual spouse at the time they file their returns. They're unable to file a joint return because they're a victim of domestic abuse, and they've indicated such on their tax return. You may be able to claim the premium tax credit married filing separately in that situation. You can't claim it if you are claimed as a dependent by another person, and in the same month you or your family member that's enrolled has to be ineligible for employer-sponsored health plan that provides minimum coverage, and are not eligible for coverage through Medicaid, Medicare, CHIP, or TRICARE. So that's why you see that people have to make a certain amount, because otherwise they want these individuals covered through Badger Care, through the Medicare program. And you have to pay your share of the premiums not covered by advance credit payments. So basically you have to be enrolled because that's the only place you can be enrolled, and you have to be making your payments. If you've done that, you would be eligible for the premium tax credit for that month. If you purchased insurance through the marketplace in 2015 and you got that tax credit applied in advance, you have to file a tax return for 2015. So even if you would otherwise not have to file, maybe you don't stand to benefit in any way from filing, you actually have to file if you had done that, if you had claimed that credit in advance. So what a lot of people did is they went on the marketplace and they looked at their options for health insurance. And when they did it, the marketplace website actually asks you, do you want to find out if you're eligible for a tax credit? And so if you fell within that income range that we showed on the previous slide, most people were told you can have $229 a month towards your premium, or you can have $150 a month towards your premium, depending on how much money you make. Most people opt to take that right away and lower their monthly payment, so you have essentially claimed your tax credit throughout the year. You're not claiming it at the end of the year. You could, and some people do. Some people may choose to pay the full amount every month and then get a lump sum tax credit at the end of the year. But by and large, the majority of people are using that to lower their monthly payment to make it affordable throughout the year. As such, you have claimed your premium tax credit, and you need to file to indicate such and make sure that everything's still in line. Again, if you need help paying for health insurance in 2016, you can activate that credit as soon as you sign up through the marketplace. So again, you can start applying it to your premiums throughout 2016 right away, and then you would have to file a 2016 return next year. just a plug, most people need to sign up for health insurance in February of this month. So there's some sites and some information online that tells you how much your credit would be, where you can figure out, how to sign up for health insurance. There are some exceptions for domestic violence survivors that allow them to do open enrollment at other times of the year. But if you have folks that haven't signed up yet, this is a good opportunity to remind them to do so and tell them they can apply their premium tax credit up front. A quick note about same-sex marriages, because of federal and state law that has changed in the last year. This question has come up before, but now any couple with a valid marriage has to be treated as married for federal and state tax purposes, including same-sex marriages. So when people in same-sex marriages are trying to figure out filing status, claiming dependency, taking deductions, maybe employee benefits or retirement accounts, but also the earned income tax credit and the child tax credit, those marriages are recognized not only at the federal level, which they have been for the last couple years, but also at the state level at this time. However, I would note that in Wisconsin, we've had some civil unions in certain areas. If you have a registered domestic partnership, a civil union, or some other non-marriage type of unification that was recognized by a municipality or a state, that will not qualify as married under state or federal law. You actually have to have gone through the marriage process in a state where that's valid. All right, some protections that are available specifically for domestic violence survivors. So you have your information ready, you've asked the questions, the survivors collected the information they have, they know about credits that are available, but there might be some other things out there that can help them. One of the main things that people don't seem to know about is the injured spouse claim through the IRS. So if a taxpayer spouse owes individual liabilities, so let's say the abuser owes child support or is defaulting on a student loan or has old tax debts from back before they were filing as a joint unit, and a married filing jointly return is filed, the IRS is normally going to swoop in and withhold your refund to pay off some of these other liabilities, even if they're not your liabilities. So if you are a domestic violence survivor and you have an abuser that has these outstanding debts that are considered basically federal debts that the government wants to intervene upon, you wouldn't get your refund because you have a married filing jointly claim. However, if you have domestic violence involved, you can file a Form 8379 to stop this and get a refund on, or get a refund on previously taken refunds. So again, you're going to have to file the 1040 or file separately to make this claim, but you have a 3-year statute of limitations for when a return is filed, or 2 years from the time tax is paid if later. If you're having money basically taken away from you that should have been your refund because you're filing with someone else who owes money, that makes you an injured spouse. You're losing money that you are technically entitled to for that tax year because of past debts or specific debts owed by your spouse. There's also the innocent spouse claim, and there are a few categories of innocent spouse relief. So the joint tax return understated the tax due. So maybe someone works under the table or is self-employed and did not give the full amount of income there, therefore their taxes were underpaid. But as the survivor, that individual didn't know, didn't have any reason to know that amount wasn't accurate. They didn't have access to the household finances. So we can't hold that person that didn't have that information liable if there is no way they had access to that information or would have been able to, amend or fix that tax return. So that's one time someone could be considered an innocent spouse. Or if the joint tax return understated the taxes due and the survivor had no knowledge and the parties hadn't been living together for at least a year, the IRS can go in and allocate the liability for that missing tax amount, the deficiency, in approximately the same manner as if the spouses had filed separately. So they'll go in and look at that situation and say, okay, really this should be treated like you were filing separately. You hadn't lived together. You had no way of knowing this. So we're going to hold one party accountable that had that information and not in this case, what we would consider an innocent spouse. They won't give refunds, but they will cut down on the taxes due. And finally, if the joint tax return understated the taxes due or the amount that the tax return showed as due wasn't paid, and it wouldn't be fair to hold the survivor responsible. This provision specifically talks about domestic violence under the IRS code. So if a spouse, says, sure, I paid the taxes, don't worry about it, and there is domestic violence, which is the main reason that the spouse has no ability to pay or knowledge of whether that was paid or not, that is a reason to consider that spouse innocent. So you can also look at marital status, why they didn't know, the benefit to the requesting spouse from the understatement or underpayment. So if that person, the abuser in the case we're talking about, is claiming all that credit, is the one that gets out ahead because they lied to the IRS, then we look at that and see, well, this other spouse is innocent. They're not really benefiting in any way from that. So these are the factors they consider, including specifically domestic violence. So if someone is an innocent spouse, there are things that you can do. You can file, like I said, within 2 years of the first collection activity against the spouse. But I would point out that if someone wants to file for innocent spouse relief, they should know that the non-requesting spouse, the abuser in the cases we're talking about, will be notified that a claim has been filed. And they get to basically respond in that case and say, oh no, she knew absolutely what was going on. She isn't off the hook. In tax court, either spouse can file a motion for a protective order to keep the address confidential. But again, everyone should know about this in advance. Everyone should know that the abuser would get that notification, and then you should proactively make sure the address is kept confidential. So we want people to be aware of that. However, even if there is a confidential address, there are certain people that will always have access to it, like the president or congressional committees. So a lot of these are probably never going to happen, but if someone also has signed off on the tax return, perhaps there's a new spouse in the picture, that person has access to it. If there's a guardian because the taxpayer is considered incompetent, state tax departments, law enforcement, anybody who's designated or, seen as a government kind of investigator would have access to that, including the president. So we just want people to know that there are exceptions to non-disclosure. We're going to quickly talk about tax fees for the Affordable Care Act. When the Affordable Care Act came out, people were really concerned about not being able to afford insurance, and then if maybe the premium tax credits weren't going to make their monthly payments low enough, they weren't going to be able to carry insurance for various reasons, or they missed the window, and then they were really afraid the next year when they filed taxes they were going to get dinged with this fee that we heard a lot about. But there are a lot of different hardship exemptions under the Affordable Care Act that say, no, it's okay. You still don't owe us the fee even if you didn't carry insurance like you're supposed to, including you're homeless, you've been evicted recently, you had a shut-off notice from the utility company, a death of a close family member, you survived a natural disaster, you filed for bankruptcy in the last 6 months, you had outstanding medical debt in the last 2 years. All these things, but also very clearly stated, you recently experienced domestic violence. So I think that a lot of the survivors that we work with would probably fall under a lot of these different categories, but also just by being classified as a domestic violence survivor, they have an exemption. So they are not going to be charged the fee even if they were unable to carry the health insurance. If you believe your income will be low enough that you do not have to file taxes, you don't need to apply for that exemption. So even if you're going to file just to get the refund like we talked about, maybe you have credits coming to you, you didn't carry insurance, you don't have to make the standard responsibility payment. There's a shared responsibility payment that the government wants to see people making. You don't have to apply for the exemption. It will ask you about it when you file your taxes, particularly electronically, but you don't have to talk about the exemption separately. So what are some resources? We're going to quickly go over some resources, and as Colleen mentioned, at the end of this you will be given a survey link so we can talk about how this went, but it will also take you to some handouts and the slides that we've gone through today, all posted on End Abuse's website. But what are some of the things you're going to see? We want everybody to know in terms of resources that everyone has tax rights. People don't generally like doing their taxes. It's depressing. It's scary. It's hard. It's confusing. But we want people to know that everyone has particular tax rights. You have the right to see and understand your entire return and all the documents that are filed with it before you sign a joint return. You have the right to refuse to sign a joint return. Married people, like we've talked about, do not have to file jointly. You might not get the great tax benefits if you don't file jointly, but you can't be forced to do so. You have the right to request an automatic 4-month extension, so Form 4868. If for some reason you can't get your stuff together or you don't have the payment you need to make by April 15th, you can get an automatic 4-month extension. They're not going to deny it, but instead of just not paying, it's much better to file for the extension. And you can always get copies of prior year returns from the IRS. So particularly important for survivors who are maybe in a relationship previously, didn't have access to those returns, don't even know what was filed, especially with electronic filing. The IRS has to give you copies of your past year returns. I would point out that if you file electronically, any of the online websites where you file, whether it's TurboTax or TaxSlayer or any of that, you should be able to download your forms from them. But if not, you can request those specifically from the IRS and they will give them to you. So that's often very important for survivors who don't know what's been filed and maybe have remedies that are available to them if they can see that. There is a lot of tax preparation assistance out there, and I'm not talking about H&R Block and other people that set up shops and run a lot of ads, but the IRS has VITA programs which offer tax-free help to low and moderate income individuals. So generally people that are making $48,000 and below have free tax help through the IRS. The IRS also coordinates specifically with AARP for low to moderate income people, specifically those 60 or older. They have this program called TaxAid, and we'll show some links to these in a second. And individuals with an income below $57,000 can always file free online. And when you go to the IRS site for free file, and there'll be a link coming up, they'll show you all the various options for filing free online. So people shouldn't have to pay to file their taxes if they make less than $57,000. So where can you find these sites? Like I mentioned, you can find a VITA site near you either by calling the IRS hotline or checking out the link below. You can check into the AARP-sponsored TaxAid sites the same way, separate number, link below. And if people want to know how to do their taxes for free, the IRS has a whole page about that. If there is an IRS controversy with a low-income payer, there are specific taxpayer clinics that will help these low-income individuals if you have income at 250% of the federal poverty guidelines with direct representation with the IRS. So you get an attorney essentially. So if the IRS says that something more is owed than the survivor thinks they owe or is trying to collect and the survivor can't pay any or all of what is owed, you can actually get an advocate set up for you and you have that representation, which is really important and something not a lot of people know about. So there is a site there that will also take you to that information. Generally, the IRS does a really good job and has a lot of information, even information specific to domestic violence survivors, and that is available on their website. If you want great information about tax credits and specific tax credit outreach, I would recommend nwlc.org, and a lot of the handouts that I will be providing in the link at the end of this are from their website that talk about the credits specifically and how that affects domestic violence survivors. And if you're wondering what you can do as an advocate working with the service recipients you have, just some simple questions to find out if you have some resources you can provide. Did you file a tax return this year? So the IRS started accepting returns as of yesterday. So before yesterday the answer would be no, but you might get some people that have filed already. The refunds are probably a few weeks out yet, but later on in the spring, did you receive your refund already? What filing status did you use? Did you file for the Earned Income Tax Credit? Has the IRS ever frozen or kept your tax refund? And have you ever received any notices from the IRS that you or your spouse owe money? All of these questions should alert you to maybe some of the remedies we've discussed today. And remember, just because people have already filed doesn't mean you can't go back and fix prior tax years. So with that,